the 4 phases of a crypto market cycle, and why it is best to buy crypto. Welcome back, everyone. If you're new here, don't forget to hit that subscribe button and turn on the notification bell so you don't miss any of our updates. My name is Kelvin. Just for your information, I am not a financial advisor, so please do your due diligence and consult with your financial advisor. My videos are only for educational and informational purposes. So, having said that, understanding cryptocurrency market cycles. Cryptocurrency market cycles describe the recurring patterns of price movement in the crypto space, often marked by periods of rapid growth followed by corrections or downturns. While crypto assets like Bitcoin are famously volatile, their price movements tend to follow identifiable phases over time. Grasping these cycles is crucial for investors, especially in a market known for hype and unpredictability. Knowing when to buy or sell can make a significant difference in long-term profitability. The 4 phases of a crypto market cycle. Just like traditional markets, crypto markets go through cyclical phases. Each cycle typically includes 1. Accumulation Phase 2. Markup Phase 3. Distribution Phase 4. Markdown Phase. Let's break each one down. 1. Accumulation Phase. Buy the dip. This phase begins after a prolonged downtrend. Prices stabilize, volatility drops, and bearish sentiment begins to fade. Most sellers have exited, and long-term investors start re-entering the market. Prices are typically at or near cycle lows. Market sentiment shifts from fear to cautious optimism, ideal for long-term investors looking for discounted entries. Though some may still fear further decline, experienced traders recognize this phase as the early signs of a future bull run. 2. Markup Phase, the bull market. Here, prices start rising steadily. More investors join the rally as confidence returns, trading volume surges, and media coverage becomes increasingly positive. FOMO, fear of missing out, begins driving retail investment. Bullish sentiment dominates. Demand outpaces supply, pushing prices higher. As prices climb, experienced investors start taking profits while retail investors continue to buy, believing the rise will never end. 3. Distribution Phase, the turning point. In this phase, the market hits its peak. Prices begin to consolidate and trade within a range. There's a battle between buyers who believe the bull run will continue and sellers locking in profits. Volatility increases as market sentiment becomes mixed. Smart money typically exits the market. Often marks the beginning of a trend reversal. This phase is the final warning before the market shifts into a downtrend. 4. Markdown Phase, the bear market. Supply starts to outweigh demand, and prices decline rapidly. Panic sets in, media turns negative, and market sentiment becomes overwhelmingly bearish, characterized by fear, despair, and capitulation. Many investors sell at a loss or try to hold through the downturn. Often ends where the next accumulation phase begins. For inexperienced investors, this is the most emotionally difficult phase. However, it also sets the stage for the next cycle. When is the best time to buy? The accumulation phase is typically the best time to enter the market. Prices are low, sentiment is subdued, and there's less hype. Long-term investors who buy during this phase often benefit the most in the next bull run. When is the best time to sell? The distribution phase is the optimal time to exit. Prices are high, media buzz is loud, and FOMO is peaking. Smart investors sell here to lock in gains before the markdown begins. How long does a market cycle last? While crypto cycles aren't set in stone, historical data suggests they tend to follow a 4-year pattern, often aligned with Bitcoin halving events. That said, cycle lengths can vary due to many factors, and it's possible to see multiple mini-cycles within a year. What influences crypto market cycles? Several factors drive these cycles, including investor sentiment, global economic conditions, regulatory developments, supply and demand dynamics, central bank policies. For example, rising inflation or regulatory crackdowns can shorten a bull run or accelerate a downturn. Why is understanding market cycles important? By recognizing where the market sits within a cycle, investors can make smarter buy-sell decisions, avoid emotional, panic-driven trades, manage expectations during high volatility, maximize returns, and minimize losses. In short, understanding market cycles is one of the most valuable tools an investor can have. What is dollar cost averaging, DCA? Dollar cost averaging, DCA, is a strategy where you invest a fixed amount at regular intervals, regardless of market conditions. It's widely used to reduce the impact of short-term volatility, helps remove emotional decision-making, avoids the pressure of timing the market, works well for long-term investors. While DCA doesn't guarantee profits, it promotes consistent, disciplined investing, especially useful in the unpredictable world of crypto. Final thoughts. Crypto market cycles are inevitable. Prices rise, fall, and rise again. Rather than trying to predict every move, investors should focus on understanding these patterns and aligning their strategy accordingly. Whether you're a seasoned trader or a newcomer, patience, discipline, and education are your best allies in navigating the crypto markets. Thanks for watching. Be sure to like, subscribe, and share your thoughts in the comments. Let's crush it this cycle. Cheers!